Okay, we are live. No good news today from Janet Yellen nor Powell. She definitely did not start the buyback program. Wells Fargo is saying this may begin in January, and the Fed was extremely hawkish. No talk of a pivot, slowing down, or finding a terminal rate that is not higher. So yeah, we'll cover this and more. It's going to be an abbreviated webinar today, just because I want to watch the markets closely and be able to adjust anything for rebel dividends if necessary. I want to note Bitcoin is down half of the NASDAQ. So markets are still looking into the future and seeing what we're looking at, and I think discounting this this bad press release here. And luckily, one of the only things up today is one of our larger positions in Boyle. So we'll cover this and more, but we will keep it abbreviated. So let's go ahead and jump into it. Here's some highlights. This is the new plan for debt issuance. It's much greater than previously anticipated. And this is going to set the framework to be able to do the bond buybacks. And what you want to notice is it's extremely heavily weighted on the 2, 3, 5 year and very light on the 7, 10, 20, and 30 year. And if they're to begin the buyback program, they'd actually be using some of the money raised from the 2, 3, 5 year to reduce the supply of the 10, 20, 30 year. And so the hope is that this would drain the reverse repo and send in a gush of $2 trillion of money that's currently on the sideline into the markets rather than sitting at the Fed. So this is definitely good news, but they haven't really activated it yet. Reminder, we took a big old profit on NRGU recently, 68% profit. I'm sure a lot of you guys saw it go up a good bit higher than where we sold it, but now it's coming back below that level. So we got near the top, perhaps not completely at the very, very, very top. High risk portfolio has a 32% return year to date. That's total return. And last year it pulled off a 233% return. So we're nowhere near the 2021 return, but to make any money this year is remarkable. Most people are just getting destroyed. And we've primarily made money on oil and gas. And we are expecting a giant reversal over the next 3 years, soon as these supply chains are fixed and the inflation begins to fall. Now, for October, we closed out a 14% return on the high risk portfolio. And for safe growth, we closed out a 31% return in October. So some really nice returns. At this point, I'm not making any trade alerts. So far, I think the analysis we have is the same. The inflation is going to fall, the CPI is going to fall, interest rates are going to fall, and the Fed is just essentially putting up a poker face as long as it can until the data starts to line up with what we're seeing with looking into the future. That said, with the news today, we got Treasuries down slightly. TLT, it's 96. We had seen it all the way down at 92 where we went long. We got the NASDAQ down 3%, the SPY down 2%, NRGU down 10. Good thing we sold that. We rotated into Boyle up 10% today. The dollar index going up a titty bit, and then Ethereum essentially trading at par with the NASDAQ, and Bitcoin at par with the S&P 500. Actually, Bitcoin's outperforming everything in terms of stocks. Okay, so we're going to skip to the trade alerts and look at our exposure. So we have a 8% crash protection play. For that to really make money, you need something like a 25% decline in a month, like we've seen in the past in the March 2020 lockdown that surprised the world. The Treasury position, I believe, is the single safest investment over the next 3 years. We're at extreme interest rates that are unsustainable and unfathomable to reprice all the U.S. debt of $32 trillion, much less global debt, which is about a total of 200 trillion. So there's no way these interest rates will stay at this level. Either the interest rates crash everything and interest rates go down, or the inflation falls globally and interest rates go down. So we can have a good or bad outcome for the stock market and make money on TMF. That's why it's such a popular product and has a very strong track record of delivering positive returns over the last several centuries, not just last several decades. So very rare to have a 2-year sell-off in treasuries and collapse the interest rates by 40%. Okay, on the offensive side, we are still long Ethereum with the Grayscale Trust at 33% of the portfolio. We've got some tech giants that have just been beaten down from Facebook to Twitter to Amazon to Google. Now Apple getting hit with some lockdowns out of China. We're picking these companies up at very low prices. And then we're betting that natural gas prices are going to go back up. So we have Europe just went nuts as the war escalated and the fear of freezing over winter. And they filled up all their tanks and paid extreme prices to do so. And now there's these massive amounts of ships sitting on the shores, unable to unload. So that's when you want to buy. That's when you get absolute rock bottom prices. And you're going to hold on to that volatility, knowing that over time they're going to draw those down, and that's when the price is going to go back up. So this has been our strategy, is to wait till these storage facilities get full and then to go long BOIL. And this will be our 3rd time hitting BOIL. And I think that's going to be the next big win that we're going to cash out probably in March of next year, maybe March or April. Okay, so at this point, I'm not too concerned about changing the positioning because I do think the inflation is going to come down on its own. The yield curve inverted is a huge problem for banks. They like to borrow short-term and lend long-term. And of course, you're going to lose money if you do that. So yield curve being inverted is a huge problem. This is a look at the money supply versus inflation. You can see the money supply is crashing and inflation's been highly, highly tied to this. So likely not only is inflation about to peak out and fall, it's likely to crash. 32% of the CPI headline, core, is based on rent, which they were measuring at raising at something like 8% in the last update. But we can see short-term data is that rent is falling, and it's falling aggressively. Here's more data showing that. But rent went from an average of $1,000 a month up to $1,386, and now it's falling towards $1,371. Now this is a lagging indicator based on housing sales, which are just completely collapsing here. We've got the largest drop in pending sales in the last 8 years. So everything is freezing up due to high interest rates. Car prices, which were leading the inflation run up, crashing at the fastest pace in history. We've never seen used car prices crash this quickly. Shipping rates from Shanghai to Los Angeles are almost back to long-term trends, just slightly over it. So I believe we are getting ready for inflation. Probably the biggest effect to kill inflation is to make people feel less rich. And so if we compare 2008 to 2022, in the 2008 crash, $16 trillion was knocked out of global equity markets, and debt markets actually went up, and that's normal. But now we're in an inflation problem, and we've lost $60 trillion worth of global debt. Ouch. And $31 trillion of global equity for a total of $92 trillion. People are going to stop spending so much money because they have less money. Okay, so that's really where we're at in the markets. Statistically, we've got a great setup. We've got massive stock buybacks. Typically, the run-up is from now through April for a stock market rally. We've got insiders buying at extremely high levels in the NASDAQ. We got Japan going into QE, which is what we believe if there's further deterioration in the US bond market, the US would have to flip off of QT to QE. This was some bad data that came in today. We did get a jump back in job openings. We don't want to see a bunch of job openings returning. That's not going to help the Fed pivot. So we can still see there's too many jobs compared to the labor supply. But interesting, the hires are slowing down. So these companies seem to be getting picky about who they'll hire. This is PMIs versus inflation rate, or excuse me, against the interest rates. And so we got interest rates spiking due to the inflation and the Fed hawkishness, raising rates, forcing the rates up. But we can see ISM manufacturing and PMI data crashing hard, and those are extremely correlated. So we basically have the Fed artificially keeping interest rates higher, even though we have all economic data slowing down rapidly. This is looking at the lows in US Treasuries, TLT. This is a great time to go big on the TLT. So we're using leverage with TMF. Stock market is relatively fairly valued at 4.6 two-year Treasury rate with 17 times multiples. Now, assuming we're about to peak out the 2-year, flatten out, and then crash it, this is likely very close to the bottom, if not the bottom in stocks. This is just a reminder, you don't want to, assuming we're heading into a recessionary period, you don't want to buy stocks at the bottom of the recession. You want to buy it way before. And so you can see in all of these examples, stock market bottoms way before GDP tanks and bottoms out and payrolls, because again, it's looking into the future. So look at the buybacks. We've got something like $5 billion a day of stock buybacks to close out the year. And just another reminder, this is the 70s when we had really bad inflation. CPI is in orange, S&P 500 in blue. And it's when the inflation peaked that the stock market bottomed. And that's where I believe we are at right now, the topping process. History of interest rates, they're going lower and lower. This is the only way governments grow money. Very funny. They asked Powell in the press conference if the government spending was a headwind on their fight against inflation. And it's the only source of inflation outside of the government creating supply chain issues, like shutting down the production of oil, like the Keystone Pipeline, killing all the leases, and then aggressively pushing war in Europe, which of course is causing energy spikes. So yeah, the government is the problem here, but he did not blame it on them. Okay, guys, so I'm gonna definitely watch the markets close out the day here, and we'll be on top of it for the next 2 days. If we get more volatility than I'm expecting, we could potentially do a trade alert. But my expectation is that we will see inflation start to fall, labor market's going to start slowing down, and that the Fed has achieved stopping the entrenched inflation from continuing. So if you're watching this video and you're not a member, call Dean at 505-322-7515 to upgrade. I'm going to go ahead and jump into the risk calculator and look at the safe growth portfolio since we just covered the high risk. Similar setup, we're at 7% in the UVXY hedge. We've got 34% in treasuries. We've got 5.5% in the S&P 500 times 3 with UPRO. We're hanging on to our leveraged emerging markets play. If interest rates are about to fall and DXY is about to fall, it's going to be very hard to outperform EDC. And we're at the market cycle where likely emerging markets outperforms US markets potentially 10-1. So very excited for that position. We've loaded up on Bitcoin, which is doing fantastic relative to its peers today at 11%. We've got 6.5% in the triple Q, and we've got a big old BOIL position, which is keeping our portfolios alive. Let's take a quick look at our returns. Looks like both went to flat, which is funny. Okay, high risk is now reporting -2 on the month, and we're on a flat return currently for, oh, it's because these prices have to get fixed. Okay, so that'll most likely update in a bit. Let's get that to load up. Okay. Oh. We'll manually input it here just so we can get a read on the ROI today. Down 1%. Okay, so we're hanging in there quite well considering we're leveraged into stocks, and we just got the worst news possible from Mr. Powell here. Okay, beautiful guys. So I'm gonna go ahead and do Q&A, and we'll have a much more optimized presentation based on the hawkishness for next week. So let me go ahead and see what questions we got. Okay, Oscar says, last week I called you out on your return, but I need to man up and tell you I found my calculation. Well, I know you're good at accounting, Oscar, as that's your profession. So, so good. And yeah, and our spreadsheets are public, so you can go in there. Yeah, so for me, it's actually it's a lot easier to publish returns when you're just trading a real account, but for us, we're using a spreadsheet. So to make my life easier over time, what I've done is I've actually just closed out the whole position, taken the sum, and then inputted that into the risk calculator. And then it tells me exactly what to do. And that's made my life so much easier because I was trying to buy and sell the exact amount based on the trade alert. And that was just so much harder. So 101,795, just to do an example. I appreciate you saying that. You know, Oscar, been buddies for about 2 years now on this. And then it'll print out what to do. Now, I don't suggest you guys sell everything every time you do a trade, because then you're going to be realizing gains and losses more often than you need to. High risk does the same thing. And so, yeah, it's good. Let's just look at, so this is where the buy and sells are calculated. And then as far as the return on the summary, this is over here. So this is calculating B1, which is real time. And then this is the in-month value. So I close that out at the end of the month. Tom Sharp says, what do you think about Peter Zahan's latest update? The guy drives me nuts. Yeah, I didn't watch that video you sent me yet, Tom. I do read his tweets. He went from thinking Russia was going to win this war to kind of shifting his view on it. So yeah, I'll try to get into that this weekend. My read on the war is it's going to last a long time. Both parties are digging in. Russia's obviously got 200,000 to 300,000 new troops coming in. So they'll be able to most likely guard the territory they've taken. And Russia is now knocking off Ukraine's energy grid. 40% is now down. But Zelensky doesn't care. And as long as the governments keep sending him billions of dollars. So yeah, I don't see any dramatic change in that on either side. Russia claims they hacked Liz Truss's iPhone and that she texted it's done to Blinken in regards to the Nord Stream. Who knows? As far as we're concerned, all of the developments are very good for Boyle. So yeah, so my basic feedback on the war is that Boyle can make us a ton of money for a third time. Steven says in 2020, much different than the 70s. Yeah. So through 2020, through the 70s, we had labor force growing and we had a great manufacturing sector. So yeah, I absolutely don't think we have a decade of runaway inflation. We got Larry Summers, tweeting his old head off saying that we're going to need to raise rates to like 7 to 8%, and who cares how many people lose their jobs. So yeah, I think that we're likely very close to the terminal rate. My guess is this is kind of what I expected from the Fed, except I thought they'd be a little more clear that they're going to do a 50 basis point rate hike in December and then 25 in the next one, which I think is either January, February, and then pause. And they didn't give us that language, but I still anticipate that's what they'll do. They just need the data to support it. So I think at this point, the single most important data is going to be not the ADP payroll, which had a lot of seasonal jobs come in. So it beat today actually, but But the catch was all the long-term jobs were falling. So I think the single most important factor now, we got rent falling, we got the housing market's completely frozen. Energy prices have stopped rising. Maybe they're stagnant. But what I believe is important now is to see the labor market start to fall. And that's what's going to be important. So that's yet to be seen. Labor market needs to cool off before we get a Fed pivot beyond just slowing down. I think we will slow down regardless, but I'm skeptical they'll get more dovish until that labor market cools off. So I believe Friday we get the non-farm payroll, and that'll be important. But let's see how markets. Yeah, so we're getting pretty good sell-off in the market here. But yeah, look at Bitcoin outperforming. So Bitcoin tends to, these smaller markets tend to front run the bigger markets. So Bitcoin tends to bottom before stocks do and starts to rally before stocks do. So that's not to say that stocks could crash dramatically and Bitcoin won't. But that's my read on seeing the S&P 500 down twice Bitcoin. Usually Bitcoin's looked at as a leveraged stock play. So if you're a crypto fan, you got to be looking at this with a big smile. You just got extreme hawkishness. He completely dismissed every concern from everybody that he's overdoing it. Completely dismissed any talk of slowing down. All he said is we've got a long ways to go, and yeah, there's nothing that positive. And we didn't get Janet Yellen doing the Operation Twist. So for Bitcoin to be hanging above 20K right now is very bullish in my opinion. But we got to be patient for longer. So this is my look at the markets today. But yeah, I'm going to edit the intro a little bit for next week. I still think the kind of predictions we had in the beginning are truthful, but it looks like it's delayed now. So the only ones really doing QE right now is Japan. China's not going to be able to do QE till the Fed stops tightening because it'll collapse their currency. Japan's currency already collapsed, so they've had no choice but to do that. So yeah, the dollar still looks like a decent play, but I like treasuries better. I think we're basically at a point where interest rates beyond this level will crush everything. So that's why we got you into that play instead of the dollar. So yeah, the next big announcement will be December for the Fed. So that's what we'll be focusing on in terms of a news catalyst that's of this scale. And then we're going to be watching that non-farm payrolls. So hopefully that's not too hot this I think that's Friday. And then we'll get the inflation print later this month. So those would be the main things I'll be watching: the inflation print this month, the non-farm payroll this month, and then the Fed's policy decision in early December. So those will be the next three big catalysts to pay attention to. But as far as just trends, the very good trend for stocks to go up over this period. We got massive stock buybacks, and it looks like the college debt forgiveness program didn't actually forgive any debt. It looks like they're quite literally sending them checks that can be spent for anything. So we still got the government running massive deficits, which in general makes markets go up. So we're not freaking out, selling everything and running for the hills right now. Fed's doing what it needs to do to officially get that inflation down for sure so that they can pivot. That's really the way I look at this. Okay, guys, if you have any other questions, shoot us an email. I'll have a more updated presentation based on not getting any of the pivots we were hoping for today. But in general, my outlook hasn't changed. I still think inflation's about to top out and fall, and then we're getting ready for a big rally in the opposite direction of how we made money this year. So again, we made money in oil and gas, and you lost money on your crypto and your bonds. I think the exact opposite is setting up till about 2025. Okay, thank you guys so much. If you're in Rebel Dividends, we'll be doing probably the small end dividend, the 0.001 on Monday, most likely. And we'll be doing our webinar on Tuesday, and we'll be back with Portfolio Builder on Wednesday. So thank you guys so much, and we'll see you back next week. Have a great weekend.